From New York City, for our viewers worldwide, happy July 4th Eve. I'm Caroline Hyde, in for Jonathan Ferro. The countdown, open starts now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up, Q3 underway with Friday's jobs report. It's in focus. Russia and Saudi Arabia extending production cuts another month. That's as Secretary Yellen heads to Beijing in hopes of easing China tensions. But we begin with the big issue, the kickoff of the second half.
Going into the second half of the year.
The second half of the year.
Be careful what you wish for.
It's the labor market and consumer spending that are the things I think you need to pay most close attention to.
Data.
The economy is pretty robust.
Things are continuing to be much better than expected.
Markets now need to contemplate what the future holds.
I think it's hard to be really positive looking forward.
We're going to have weaker growth.
Weakening in the second half.
We are slowing. There's no doubt about that.
We're expecting margin compression.
We're actually starting to creep back towards overbought territory.
There's room for a pullback.
We're very cautious. Whatever this is, whether it's a recession or a growth scare, I do think it's starting.
Let's dig in, because today we do see a bit of a mute market, but still the Nasdaq 100 drives higher after a phenomenal first half. BNP's Sam Linden-Brown joins us, Invesco's Christina Hooper. And Christina, I want to start with you there. Welcome to the show this morning. And I'm interested in what's happening in terms of whether the second half can in any way sustain the fuel that we saw in big tech in the first half.
Well, Caroline, what I think we're going to see is a period in which markets sit in a trading range, and perhaps we see a small pullback in the next several months. Clearly, there has been a lot of excitement in the first half of the year, and there needs to be time for that to be digested. Having said that, though, I think by the end of the year, we'll see that the S&P 500 has finished higher.
Okay, interesting. Just to dwell on that, finished higher from where it is now? Finished higher just all on out on the thriving first half of the year?
From where it is now, but modestly. Okay. What we're experiencing right now is a period of uncertainty. We've gotten so much hawkish Fed speak, although I think it's largely bluster. What the Fed needs to do, though, is keep a lid on financial conditions really easing. And so it's important that we hear that very aggressive Fed speak. It should cause some kind of pullback in markets, and that's what we need to see right now. But I think by the end of the year, it will become clear that there will be an economic recovery in the offing in 2024, and we'll see some movement upward in stocks.
How global is that, Sam? Because I'm looking at the Euro Stoxx 50 on track, if we hold this level above 4,400, to be the highest since December 2007.
We'd have sympathy with the view that Christina put forward of an economic rebound in 2024, but we'd be a little bit more cautious on the path that we'll need to first get us there. And the key point on our side here is, in order for central banks to stop hiking, we think they need to see more evidence in the persistence of the inflation trend turning south from the very strong levels that we've been getting recently. In order for that to happen, we think the market needs to price in more of an earnings recession, because without wage growth decelerating, which will only happen if the unemployment rate rises, which will only happen if companies lay off workers because they're less confident about the forward-looking outlook, then we're not too convinced that inflation is going to fall to a level that's acceptable for central banks to stop, as Christina said, this recent hawkish rhetoric.
Let's just go cross-asset for a moment, Sam, and dig into some caution we've heard around the debt markets, in particular corporate debt as well. I heard some of those alarm bells being rung. It was in the FT, I think it was. The CIO of PIMCO, Dan Iverson, obviously a friend of this show for John Ferro, he was saying, look, they're preparing for a harder landing. They are worried about parts of the debt market, particularly leveraged parts. Do you think that this is a buying opportunity in bonds as well as stocks, or no?
In bonds, I think the cyclical case to own duration in the US is compelling. The problem is, if we continue to see this economic resilience, that's really telling the market that neutral rates, R star, is higher than was widely perceived. And if that's the case, it means that we could be due for an upward adjustment in longer-term maturities rather than what we've been seeing more recently, where when the curve flattens, it's bear flattening, with more tightening getting priced into the front end, but with that not permeating to longer maturities. Our view going forward is that what we might actually see is the market starts to price economic resilience more in longer maturities. It's a dynamic which would imply it doesn't just mean the Fed have more work to do, R-stars higher. It's a dynamic which would imply that some of the inflation risks, which for the past decade were priced to be asymmetrically lower, are now actually asymmetrically higher. It's a dynamic which we have a lot of sympathy for at BNP.
And sympathy for also, going back to the equity markets, Christina, an alarm when it comes to a need for breadth in this market. It was interesting that JP Morgan in particular sounding the alarm on the equity rally today, really writing that the consensus view that the worst of the pressures is behind us will be proven wrong, as the impact of monetary tightening has historically worked with a lag and certain growth supports are waning. Unless there is continued broadening in leadership, the overall index could struggle to advance in further second half. You were just saying how you anticipate, Christina, the second half to see some sort of growth in the S&P 500. Where is the breadth going to come from? Which sectors, which industry groups can start to outperform other than a few names in the NASDAQ?
So I think the breadth comes from the end of the recognized end of tightening and the expectation that an economic recovery will come. So we'll see cyclicals perform better. We'll see smaller caps perform better as markets anticipate that recovery. That tends to be the segment of the market cycle when we do see more breadth. This is rather normal to see this kind of a narrow breadth in this part of the market cycle as we anticipate the slowdown.
Let's just talk about anticipation of a slowdown and really investors tempering their expectations after what has been just a phenomenal first half of the year. As I've been mentioning, the NASDAQ 100 closing out its best first half on record. Let's look back, let's look forward. None other than Bloomberg's Katie Greifeld doing double time today.
And just to look back briefly, remember back in the start of 2023, really strategists were anticipating a flat S&P 500. That's not what we've gotten so far this year. The S&P 500 rallying about 16% year to date in the first half. Then you take the cross asset look. You've actually had crude come down pretty sharply, down 11%. Copper off as well. Not as much as you would think when you think about what we've seen since the end of January. Overall for the year, though, only off about 0.5%. And you also have the Bloomberg dollar down about 1%. Not exactly the wither the dollar expectation that we had, again, coming into 2023. But now that we've had this really strong first half in the equity market, the question, of course, is where do we go from here? There's been a lot of calls to the downside that basically we're going to see some of that strength be given back. But if you look at the historical data, when you look at double-digit gains in the first half, typically it leads to strength in the second half. The most recent example we have is from 2021. Of course, the double-digit rally that we saw in the first half of that year was met with an 11% rally in the second half. Whether this happens again, whether history repeats itself, we'll see. But I do want to talk about the bond market. I find this chart absolutely amazing. You're looking at the 10-year Treasury yield. It entered the year at 387. It's at about 383, 384 or so right now. So almost flat for this year, Caroline, though, with a 75 basis point range.
Really, Katie, always going cross-asset for us. We thank you. And let's stick with going cross-asset. Let's just pivot back a little bit to what Deutsche Bank was saying. George Saravalos, who's been expecting the consumer in particular to play a key role here, writing, quote, look, the pretty uninspiring consumption picture points to imbalances within the economy and restricted supply driving inflation, actually, rather than excess demand. The second half, he says, will be all about whether the market is right to expect inflation to come down as these imbalances get resolved while the consumer stays, quote, boring. Sam Linton-Brown still with us, Christina Hooper. Sam, how much is the consumer going to be boring in your mind's eye?
I think the consumer's clearly absolutely key here. And I think that the key point I'd make is if the market and the equity and credit market in particular is right about the outlook for growth that it prices in, strength in the consumer, especially the US consumer that it prices in, then our view at BNP Paribas is the inflation rates won't fall down to a level acceptable for central banks to stop hiking. And so I'd argue you have this discrepancy between front-end nominal rates, the inflation market, and the equity market. If the equity market's right on growth, that implies no recession. That implies inflation will stay too high, and that means central banks will have even more work to do.
But is the market right, Christina, from your perspective, or is the market well ahead of itself?
Well, certainly the market has gotten ahead of itself, but it's moving in the right direction in terms of expectations. I think we're not going to see a hard landing. We're going to see a bumpy landing, which means that it is not going to be easy. There will be economic damage, and certainly we'll see some pressure on the consumer. But I think the key metric that we haven't looked at or we haven't talked about today is consumer inflation expectations. We got two very important readings last week, Michigan consumer inflation expectations, and then also we got a euro area inflation expectations. And what that tells us is that inflation expectations, especially for the one-year period, but also for the longer term, have come down very significantly. And that is so important because that helps consumers, that helps tell us that consumers are going to sit on their hands and wait for better prices to buy things. If we look at 1980, inflation expectations were at about 10% for the 1 year ahead period. Of course, that created a self-fulfilling prophecy where consumers continued to buy because they expected prices to go up so much. We're in a very different position today with inflation expectations at around 3%. Over the longer term. That means that consumers are going to sit on their hands, and of course they're also under pressure. So this is an environment where inflation is going to come down. Yes, core has been stubborn, but core tends to follow headline, and headline has come down a lot.
Sam, to that end, consumers sitting on their hands, are they therefore saving? What's been interesting is that they haven't as yet. And Bridgewater's co-CIO, Greg Jensen, was actually on the Odd Lots podcast recently, focusing on the impact of higher borrowing costs, saying that in his view, you will end up with growth disappointing a bit and inflation disappointing on the high side. And they're saying it's probably going to be bad for bonds and equities and generally weaker growth. And if that weak growth starts to translate into rising savings rate, you can easily end up going into a recession. Any part of BNP have sympathy with the recession call?
I think first off, I'd very much echo the points that Christina was making around the lack of parallels when it comes to inflation expectations with what we saw in the 70s and 80s. Very much on the same page here at BNP Paribas with that view. I think in terms of the outlook for the US consumer in the context of savings, what we've seen is that savings were super high because of COVID. Those savings have now been run down materially. So when we look at excess savings in the US, they reached a level in 2021 near to 2.4 trillion. And that level has now been run down to, on our estimates, closer to $700 billion. So there's still a buffer, which means that the lagged impact of monetary policy may continue to be slower than some expect to slow down activity in the US, but that buffer has certainly alleviated to a large degree. I think another key element here for the market outlook, above and beyond the economic fundamentals in terms of what's going to drive prices, is the shift that we're going to get in liquidity dynamics in the second half of the year.
Well said. Sam Linton-Brown sticking with us, Christina Hooper as well, joining us to just have a little look on what's happening right here, right now on the movers of the day ahead of the opening bell. Abigail Doolittle, take it away on some of the movers.
Well, Caroline, we may have the futures basically flat here in the pre-market, but one space is really popping higher. That, of course, is the electric vehicle space. Tesla leading the way. Well, actually, Rivian now is, but Tesla up 5.5%. Record deliveries. They delivered more than 466,000 cars worldwide on those pricing cuts. But JP Morgan is saying that some of this stabilization may suggest that we also have demand stabilizing as well. Nikola going along for the ride, but Rivian up 8.4%. They also put up big numbers relative to the company. They delivered nearly 14,000 vehicles. The expectation was closer to 12,500, and they're saying that they're on pace, Caroline, for 50,000 annual production, that guidance. And I will note, I did actually see within the span of about 5 minutes on Saturday, 2 different Rivian vehicles.
Rivian spotting in the wild. Abigail Doolittle, we thank you. Meanwhile, coming up, look, interesting that some of that pickup in EVs was happening in China, even as China's weaker than expected recovery.
The reality is that people have given up on the Chinese recovery. The major problem here is that, China's moving off its old economic growth model, but it hasn't moved comfortably into what's next.
Manufacturing activity slowing in China. That's as Secretary Yellen prepares to visit Beijing. That conversation up next. This is Bloomberg.
The major problem here is that, China's moving off its old economic growth model, but it hasn't moved comfortably into what's next. You're seeing much slower growth overall. You're going to see a long-term structural slowdown in the Chinese economy, and that they haven't truly prepared the world for that or their people for that.
And that data bore out overnight. China's manufacturing activity just slowing in June, adding to that evidence that its overall recovery is cooling. Meanwhile, of course, Treasury Secretary Janet Yellen is heading to Beijing this week in an effort, of course, to keep on mending that US-China relationship. Bloomberg's Enda Curran joins us now, and we'd anticipated some sort of meeting. Interesting, there's been a changing of the guard of who indeed she's going to be meeting with.
Yeah, this meeting has been a long time coming, Caroline. The basic premise of it is that the Treasury are managing expectations. It's all about improving communications between the US and China, perhaps looking for areas where there can be some cooperation, but that's expected to be modest. But there's certainly no indication that there's going to be any kind of a substantive breakthrough in the issues. Remember, Treasury Secretary Janet Yellen's purview is the economy. She can't really stray into terrain like national security or trade or other areas. She'll probably be meeting mostly with the economic officials, Caroline. Unlike Secretary of State Blinken's visit a few weeks ago, it would be less likely she would be going up to meet the top of the government, which of course is President Xi Jinping. So I think the expectations in this one, as I say, they're being managed. The focus will be on the economy and probably several meetings with economic officials in and around her rank.
Enda Curran, thank you for bringing us that. We'll anticipate that after the joyeties of July 4th celebrations here. Meanwhile, Sam Linton-Brown and Christina Hooper are back with us. And just, Sam, bring us your global perspective here. China, how much of it is a weight on global growth? How much are you concerned by the fact that the economy hasn't expanded or picked back after COVID as many had anticipated?
At this level, I think a lot of the pessimism on the growth backdrop in China is now quite well reflected in the price, and probably what we're actually likely to see is that the next big repricing in the market, we think, will be from very pessimistic growth expectations to slightly less pessimistic growth expectations. The catalyst for that change, we think, will come from a policy easing package that will be announced towards the end of this month and the beginning of August at the next Politburo meeting. And we think that will reprice market expectations slightly more on the positive side for China from what we'd argue now is really quite pessimistic.
Christina, that's the PBOC at play. What about the limits from a geopolitical perspective? We're just seeing overnight news that, look, China wants to be limiting metals used within chips. Of course, this is this tit for tat, the trade, the tech war that's going on. How much is that a limitation as well on global growth?
Well, it certainly can be modestly problematic as well as, mildly contributory to inflationary pressures. But I couldn't agree more with Sam that the view on China is very, very pessimistic. It's priced in, and I don't think it deserves to be that pessimistic. Certainly over the weekend, a monetary policy report came out that suggested there's a need for more monetary easing. I think we're going to see that. I think we're going to see some fiscal stimulus coming from China. And we have to recognize that the manufacturing PMI readings reflect global demand. And as we know, central banks are slowing global demand by design. So that shouldn't be a reflection on real problems within China. I think it's much more accurate to look at services PMI. That's remains still quite robust. Again, China has an economy not dissimilar to other economies after they reopened, where we saw things very lopsided in that manufacturing was weak and services was strong.
I like that you bring in manufacturing because we're about to get a manufacturing reader here in the US, of course, ISM a little bit later, the S&P reading just in, 25 minutes. Sam, European manufacturing has been slowing. We've seen that sub 50. We've also, of course, had China's manufacturing coming in a little bit weaker than anticipated overnight. How much is the China slowdown a European story as well?
I think there's certainly a good case to be made that the linkages between the two economies have contributed in sort of a circular way to the concurrent downside misses we've had out of both the Eurozone and China. I think the slowdown we're seeing in manufacturing, though, as we heard last week in Sintra from President Lagarde, is yet to feed through to a sufficient extent to services such that it's going to alleviate enough of the inflationary pressure in Europe that it really has a big impact on the outlook for ECB policy. So we think that despite the weakness that we've had in European manufacturing, the ECB will continue to hike rates. Our central case is 225 basis point moves from here, so taking the policy rate to 4%.
Okay, at that level, we've been talking, Christina, a lot about the 4% level here for US Treasuries, for example, that becomes the buying opportunity. When we're thinking about rates still potentially being hiked as soon as July, but then a pause there, is that your perspective for US central bank policy as it stands?
I still think there's a very good chance we don't see any more rate hikes from here. We could certainly see one more, but that is not my base case right now. Just given, again, looking at the mosaic of data, including inflation expectations. So, but if we do see one or two hikes, this still represents an attractive buying opportunity for fixed income, especially investment-grade credit. Longer duration, at least a portion of one's portfolio being longer duration. Historically, this has been a good time to buy.
It's been wonderful having a good time with you both this morning. Thank you so much for the perspectives across asset today. Sam Linden-Brown giving us the global perspective, Christina Hooper for dishing out on credit there. We thank you both so much. Meanwhile, coming up, the morning calls. And later, well, Tabacum's Michael Purvis joins us around the opening bell with his outlook for the second half. From New York, this is Bloomberg. This is Countdown to the Open. I'm Caroline Hyde. Let's take a quick look at these markets because, well, after a run-up like none had expected in the first half of the year, we're taking a breath as we head into the second. Volume's thin. We've got S&P 500 just up about 0.1% in the futures market, but NASDAQ 100 futures up again after what is a record start to the first half of the year. Time now for some morning calls, some of the analyst recommendations this morning. First up, Goldman Sachs actually adding Southern Company to its conviction list, saying it's uniquely positioned to provide stronger clean energy growth. Next up, Wolf Research upgrading Lazard to peer perform, seeing an attractive valuation with a clear path to better margins. And finally, Canaccord raising its Tesla price target to $293. Look, it's expecting the automaker to continue gaining market share after those record Q2 deliveries. Meanwhile, coming up, look, Tesla providing an early boost for big tech. We saw the NASDAQ 100 futures there. It's logging its best first half on record. That conversation up next with Talbacken's Michael Purvis. You want to stay tuned. Thin liquidity ahead of a July 4th celebration. From July 4th Eve, this is Bloomberg. This is Countdown to the Open. I'm Caroline Hyde, in for Jonathan Ferro. He is missing. Well, it looks like the nice see some fun going on. People in fancy dress ahead of July 4th celebrations. A day ahead of that, volume's going to be muted. We are seeing the S&P 500 futures just off by about 0.1%. But the NASDAQ 100, with celebrations coming the VEX indices today, managing to push on higher after a phenomenal record first half of the year. Let's go cross asset a little bit, though, as well, because Europe, we are seeing strength in European stocks today, at least on the Euro Stoxx 50, managing to potentially close at the highest since December 2007. A little bit of weakness across the DAX, but we're looking at euro dollar just flat on the day, 1.09 as the dollar stays weaker, well, relatively flat on the day too. 10-year yield getting a little bit of a bid there, 2 basis points on the downside in terms of yields, 3.81. And New York crude only up 0.3% now after that news coming out of Saudi and Russia. We'll dig into it in a moment. But one stock to watch, of course, at this open, Tesla helping that NASDAQ 100. Shares jumping after reporting record Q2 deliveries. Ben Callow writing, quote, "It's a big beat. People were still bracing for another round of price cuts, but these numbers make that less of a risk." Joining us now, my friend, my co-host of Bloomberg Technology, Ed Ludlow, on the case. And, I mean, it was a big beat, but not only, it seems, for Tesla in terms of EVs.
Yeah, a lot going on. Numbers flying around the world from all kinds of EV makers. Tesla delivered 466,140 units in the quarter gone. That was a big beat relative to the Bloomberg analyst average estimate of 448,350, up 83% year on year, that delivery beat, which is interesting. It shows that they continue to grow at a phenomenal rate. what's interesting is it's still a case of Tesla producing more vehicles than it's delivering. But Ben Callow, among the analysts, noting that the gap is actually shrinking, and less concern in the market now about further price cuts. But we also got numbers from BYD. BYD almost doubled its deliveries of battery electric vehicles to 352,000. You were noting in that LinkedIn post earlier, right, Caro, that you throw plug-in hybrids to the mix, and BYD delivering more than 700,000 vehicles in the quarter gone. Ooh. It's the biggest brand name going when it comes to China. And remember, in that market, many more players, many more models. Tesla faces much stiffer competition there, though it's the clear market incumbent here in the United States. Real quick mention of Rivian. Those dropped this morning as well. Production number 13,992. Delivering 12,640. Real ramp up from their own production numbers in the first quarter. They've shifted a key component in-house, the Enduro motor. They were using an off-the-shelf product from Robert Bosch. That seems to have helped them address some of the supply chain bottleneck that they had, and that stock, well, up almost 9% in early trading.
6:32 a.m. in San Francisco. Ed, how close are you to your 6,000 tweet limit as a Blue Twitter subscriber?
Yeah,
today?
really interesting. Well, that didn't last very long, did it? I think we're up to 10,000 now. But,
Oof.
you know, again, it's another example of Elon Musk just making a policy decision on the platform. How long does it take to view 10,000 tweets? As you know, you and I both spent a lot of time on that platform. But over the course of the day, they kept edging it higher. Yeah. A lot of criticism and chat about that on the platform as well.
If I believe in anyone who can get to 10,000, it's you, Ed Ludlow. Thank you. Meanwhile, sticking with tech, Apple slashing production targets for its Vision Pro, according to the Financial Times. The FT writing, quote, Apple has been forced to make drastic cuts to production forecasts for the mixed reality Vision Pro headset, hailed as its most significant product launch since the iPhone. Bloomberg's Abigail Doolittle is all across this one, and it is a big cut, it feels like.
It does feel like it's a big cut. On the other hand, this is not clearly their main driver from a revenue standpoint. So the stock down mildly. That said, the stock breaking a 4-day winning streak, the longest winning streak in more than a month. And of course, one, Caroline, that took the stock above that $3 trillion market cap level that everybody was watching. It is still above that level. Relative to the cuts, they are now preparing to make fewer than 400,000 units of the almost $3,500 headset in 2024. As you mentioned, this is a report out of the FT, and there's some suppliers that are saying that they're only ordering enough parts for 130,000 to 150,000 units. So if that's the case, that's a pretty significant cut. But again, this is not their clear revenue driver, and if it should be at some point in the future, that would be a far way out. My question is whether, how many people are actually willing to spend that much money on this product. I guess time will tell on that one, Caroline. But, as you know, it all comes down to the iPhone. The stock right now down about 0.3%.
Interesting supply chain limitations there, Abby. We thank you. Meanwhile, over to financials. Big banks, including JP Morgan, Goldman, they're announcing higher dividends after every lender subject to this year's stress test passed. In fact, JP Morgan CEO Jamie Dimon saying, quote, we remain prepared for a broad range of potential outcomes, including potentially higher future capital requirements from the finalization of the Basel III capital rules. Joining us now, Bloomberg's Katie Greifeld. And, well, it seems across the board, resiliency is the word of choice.
And you are seeing the banks lift a little bit this morning, even though this is typically how it goes. Of course, the big banks, they pass the annual stress tests and then they boost their dividends. We got that this year as well. The 5 biggest banks out with their new quarterly dividends at the close of trading on Friday. Goldman Sachs, the new number is $2.75. That's an increase of 25 cents. That's the biggest boost among the big 5. You also have JP Morgan now. That quarterly dividend clocks in at $1.05, up from $1. And even Citigroup went through with a bump of about 2 cents, even though that bank in particular faces higher capital requirements because of its test results. But looking ahead, though, now that we got the dividend increases, we might not get that paired with higher share buybacks. As you mentioned, of course, the big banks are under a lot of regulatory scrutiny right now, and that could limit those commitments that we get later on, Caroline.
I mean, Silicon Valley Bank feels so long ago now, but what an impact it had across the entire sector. Katie, thank you so much. Meanwhile, we're going from the big banks back to the big tech story. Talbacken's Michael Pervez writing, cracks are spilling into the NASDAQ 100. What we see developing here is the continuation of a risk-on sentiment, but this risk-on is increasingly obvious through rotation into value and cyclicals. I'm pleased to say Michael Purvis joins us now. So NASDAQ 100, the run-up, it's over, do you think?
Well, you never know with a rally that has been so strong, so compelling, and with a fair amount of FOMO driving it. Bottle rockets can, shoot pretty far before they do roll over. But I think, if you just look at some of the momentum indicators on the NASDAQ, you're starting to see them in a very different place than you had earlier this year. And one thing, if you step back, NVIDIA, the third largest position in the NASDAQ, fourth largest in the S&P 500, the technicals on that stock in particular look really cuspy right now. Look like they're really rolling over. So I'm not, it may be a stretch to say if NVIDIA rolls over, the rest of its peers, Apple and Microsoft and so forth, have to roll over as well.
Yeah.
But it's something I'm watching very closely right now.
And how were you playing that, Michael? Because I know you were looking at options when it came to NVIDIA.
Right. Well, I'm not quite there yet. It's a pretty aggressive call to go out with saying buy puts on this stock that is just absolutely soared and has a lot of FOMO going into it. But I will say this: I'm getting closer every day to actually going out and pulling the trigger on that idea.
Wow.
There. So I think it's probably in some ways a more obvious play than the NASDAQ, which of course is it is a basket of stocks and there are some reasonably good stories here. But I think, look, you step back, you're looking at a NASDAQ that's had an enormous PE expansion. Here, we're up to 26.5 times, which is about as high as we got during the heady days of late 2021. And this PE expansion has happened during a period where interest rates keep, across the curve or keep edging ever higher here, right? So, you're dealing with a NASDAQ equity risk premium that's actually negative right now.
Yeah.
There. So I think at some point, you are going to start seeing that stuff roll over. And I think we're getting close to that point.
Is that point, Michael, is that point earnings? Because we were hearing, for example, from JP Morgan, seeing earnings risks as after what has been an amazing first half, and the strategists there writing that we were bullish on earnings for the past 2 years. While the second quarter could still be resilient, we do not expect upgrades for the rest of the year. What about downgrades? What about the unsettling notion that earnings are going to fade this?
Yeah, well, certainly at the index level, let's just talk S&P 500 for a moment. There, I think there's a strong case to be made that earnings will be okay, but they won't be great, right? And so how much do you really want to pay for, mid-single digits earnings growth into 2024 when nominal GDP, which helped inflate earnings last year, earnings were up 10% last year, a big surprise for most people, right? But that was a lot of inflation, and that as that inflation comes out, and it's coming out, for the broader index, you will start seeing, I think, sort of like a return to, sort of mid-single digit earnings growth as we get to 2024. Do you really want to pay 19.5 or 20 times in the S&P 500 for that earnings stream? I think that's a real big question. As it relates to things like NVIDIA, I think there's a big question as we get into the second quarter season, which is now just, starts a couple of weeks from now, where the earnings are, I think like earnings estimates for NVIDIA basically doubled in the last quarter. Can they keep that excitement and that upward trajectory going higher, or do they kind of steal the thunder for this quarter or the next quarter there? I suspect that's the case there. So I think that's going to be another case where people are going to be like, look, I have my fill of NVIDIA. I'm paying 25 times revenues for a stock that's massive. It's a very scaled company, right? There. And so I think valuation does matter.
In 30 seconds, you talk about the rotation. One area to rotate into at the moment?
Well, look, I mean, industrials have been pretty good. I think they're going to stay pretty good with the whole relocalization theme. I think that is a place where you're going to see earnings doing pretty well. If you look more broadly at the S&P equal weighted index, which is effectively a value proxy, there you're looking at a case where the PEs there are actually really pretty reasonable there. They're actually lower than they were last August here. So I think that at the index level, the S&P equal weight, I think is a pretty safe place to put your money there.
Yeah.
Within more specific sectors and so forth, industrials, and believe it or not, yes, banks too.
Michael Purvis sticking with us. Pleased to say we can go more fundamentals in a moment. But coming up, more oil supply cuts in the pipeline.
The cuts of the OPEC Plus actually started back in November. where we still didn't have information how demand is going to be panning out, you can actually say that OPEC Plus has been fairly proactive and and had a very quick reaction in 2023 when the global demand numbers didn't pan out.
More and more next. That conversation coming. This is Bloomberg.
You can actually say that OPEC Plus has been fairly proactive and and had a very quick reaction in 2023 when the global demand numbers didn't pan out. In the short term, there is very little even OPEC Plus can do if there is a demand destruction in the market. Without this OPEC Plus action, I think we could be down to 60s in oil prices.
Let's talk about it a little bit more. Saudi Arabia, Russia announcing fresh cuts of their oil supplies on top of existing curbs made in an agreement with OPEC Plus, of course. Now, the move pushing oil prices a little earlier higher, but now sort of steadying. Let's talk about it all with Bloomberg's Will Kennedy joining us. And it was anticipated by the market, right?
Some of this was anticipated. The Saudi extension, I think most people thought would happen. They'd said a month ago that they would cut their production by an extra 1 million barrels a day in July, and they've decided to extend that into August, but most people had priced that in. I think the Russia announcement that we saw today that they would extend their curbs, not to production, but to exports by 500,000 barrels a day, was more unexpected by the market. But the problem we have there is that Russian compliance with its existing obligations has not been all that it could be, especially in the eyes of those who count tankers and look at them. So I think when it comes to Russia's commitment, people will want to see it actually go into effect before they draw any conclusions about what it'll do to global supply and demand balances.
Well, Kennedy, we thank you for bringing us up to speed with the world of OPEC and OPEC Plus. Meanwhile, of course, oil feeding into manufacturing and the US PMI data just crossing as we look ahead to, of course, all-important ISM a little bit later. US payrolls, of course, come Friday. To break it all down, Bloomberg's Michael McKee. And when we're looking at the S&P global US manufacturing data, what do we see?
We're still seeing some contraction, but what's interesting is the numbers come out exactly the same as they were last month, 46.3, and that was what the analysts had expected. So it does show that there's still some contraction in U.S. manufacturing. Now, at the top of the hour, we get the ISM manufacturing report, much more important to the Fed and to U.S. economists, and in that we're expecting a slight gain, but still a contraction. The forecast for 47.1 after 46.9. Going to be, though, a busy week, Caroline. We have today the ISM numbers, of course, and tomorrow you can watch the fireworks. But Wednesday, we get the Fed meetings. And look at Thursday. Jobless claims, JOLTS, ADP, and ISM services. And then Friday, one major report that people kind of follow.
And remind us, I mean, how major it was last month. I mean, again, absolutely phenomenal strength and an almighty move on the bond market because of it.
Yeah, 14 months in a row, the number has come in higher than analysts' anticipation. So we'll see if that string gets broken. But even if we match at 225 right now, and that'll change a bit between now and next Friday, that would be still a very strong number. And the forecast for unemployment is that it goes back down again from 3.7 to 3.6. So the labor market's still very strong unless we get a surprise. Fed's going to be watching that.
They certainly will be, as we will as well. Michael McKee, thank you for breaking it down. It's going to be a busy week amid those fireworks. Michael Purvis still back with us. Bring us some fireworks, Michael. What are you expecting in terms of what's the overall fundamental picture of the U.S. here? Is the Fed going to have to hike in July? Will it do so afterwards?
Look, in terms of economic strength, yeah, I think we're going to see more of the same for quite some time. I think there's a lot of structural factors sort of underscoring this. What I think is happening is a stronger shift to a higher nominal GDP, inflation higher than it has been before COVID, but not a recession per se. Some growth to go along with that there, and that should keep interest rates higher. And I think I suspect that if the employment numbers on Friday morning are come in as advertised right now or stronger, yeah, I think that's probably going to be a July hike. I think what's much more interesting and in some ways more relevant though is whether the cuts that have been priced in the market quite extensively right after the Silicon Valley Bank collapse, whether those keep getting eroded and you're starting to see really a much sort of flatter picture for Fed policy over the next 24 months. And I think that's where this is going right now, which probably ultimately means 10-year yields have to come up edge a bit higher there into a sort of a non-recessionary, but sort of a persistent strength and not quite collapsing inflation picture. Yeah, I think the Fed is not done yet.
But if we get, say, a 4% level on the 10-year, does that just bring in more buyers? Is there some sort of level out? Is there a top that we end up having because demand will just rush back in?
Look, I think 4% is a big, nice round number. You've seen buying there at that level historically over the, through this whole cycle. Could we get through that into 4.25 if the Fed deems it necessary to keep pushing, not just up in July, but maybe, another one in September and perhaps even more later. But again, I think the question comes down to whether the Fed just sort of advertises what I call camping out a terminal, and they really work the x-axis and as opposed to tweaking rates up and down. If that's the case, then I think they're going to set, the market's going to read it as policy rates are going to stay higher longer, and therefore you will get through 4% and maybe to 4.25. I would be surprised we get much higher than 4.25 at this cycle, but I think that's increasingly where this is going right now.
And I want to come back to you on your calls from sectors on the back of that move in bonds. Let's just, while we look at the equity market, S&P 500 currently flat, dig into some of the industries, some of the movers out there. Abigail Doodle, just break it down. What sectors are on the move today? How much is the oil market feeding into it, for example, those cuts?
Yeah, well, it is interesting, Caroline, because as you mentioned, the S&P 500 is basically just flat. But we do have some sectors on the move. Consumer discretionary, the best, up 1.5%. Not surprisingly, that has everything to do with the likes of Tesla moving it higher. As for energy, right behind it, but it's interesting, Caroline, just a small gain there, up about 0.2%. To the downside, healthcare and industrials, healthcare down by 1.1%. And then let's go back to Tesla and some of these other automakers, because we now have the S&P 500 auto index up. Take a look at that, up 16.2% over the last 5 days. Its longest winning streak since June, but not surprisingly, its best winning streak since early January. Again, having everything to do with those Tesla numbers.
And very briefly, of course, going back to Michael Purvis, Abigail, you said you like banks, the yield curve, the inversion. Any other sectors you want to call out for us?
Well, look, I think there are selected materials here. I think, materials have been very soggy. The failure for China to really launch here the way certainly I expected earlier this year there. But I still think that there is ultimately a different supply story going across so many of the materials names here. And I think when you think about the relocalization of what's happening, you're seeing this explosion in factory builds in the Southeast right now, in the Southwest and other parts of the country. So that means that a lot of people that are making the inputs for that, whether it's steel, whether it's cement, and so forth, those names can be bought pretty cheaply there. And then away from that, again, like Bank of America is trading at 8.5 times earnings. It's not a very exciting story there, but it's, the S&P 500 is 19.5 times earnings, and certainly skewed by Nvidia and the other big tech names. But still, I think, buying a company it doesn't have an amazing earnings story, but has a decent earnings story here into a higher rate environment where net interest income is going to be pretty good, I think is probably a pretty decent play here.
The
it's not
rotation
going to make
story.
you super rich, but it'll be solid. Yep.
Michael Purvis, happy 4th of July. Go celebrate. Thank you. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for the trading diary. What you need to be watching this week. Of course, U.S. stock markets, they're closing early, 1 p.m. Eastern today. Bond markets, that's 2 p.m. U.S. markets also closed for the 4th of July holiday tomorrow. Then we get the fireworks of the Fed minutes on Wednesday. Secretary Yellen heading to Beijing come Thursday. And Friday, you know it, we'll round out this week with the all-important U.S. payrolls report. Just a phenomenal week to be getting your teeth into when it comes to fundamentals. But Go have a really enjoyable shortened day and exciting July 4th celebration. This was Countdown to the Open, and this is Bloomberg.